Hey everyone, it's Alan back again with another video, and today I wanted to talk about something really interesting that was just brought to my attention. Apparently there's now an ETF out there, and there's another one launching soon that pay dividends on a weekly basis, as opposed to monthly and quarterly like all other dividend ETFs out there. I figured covering this ETF would go well with what I normally talk about on my channel, which is aggressive dividend investing. So today my plan is to take a deep look into this ETF and present you all with what I find and see if there's any value in these funds or if it's just a cheap gimmick. Before I get started, if you're interested in high yielding investments where you can earn a large amount of passive income, please consider clicking the subscribe button below. Dividend Bull revolves around aggressive dividend investing for people who want to earn large amounts of passive income sooner rather than later in their lives by targeting higher yielding ETFs, stocks, closed-end funds, etc. So if that sounds interesting to you, feel free to subscribe and check out some of my other videos for some more content. So the weekly dividend fund that was just launched is the SoFi Weekly Income ETF, ticker symbol TGIF. TGIF is an actively managed ETF that seeks to provide weekly income by investing in investment-grade and high-yielding fixed income securities. It's expected to distribute income on Fridays, which is obviously what the ticker symbol points at. The fund was just launched back in October of 2020, and right now it's trading at $103.47 a share, and it has a dividend yield of 2.51%. For those of you who might not be too familiar with the company behind this ETF, SoFi is a financial services company that's been around since 2011, and they're headquartered in San Francisco along with all those other tech startups. But they only recently started branching out into investment products like ETFs back in 2019. SoFi is probably most well known for their student loan refinancing services, so I would suspect that millennials and Gen Zers are probably much more familiar with this company. But like I mentioned, in recent years they've been branching out into a whole lot more areas in finance. They have their own brokerage platform where users can buy stocks, open retirement accounts, buy cryptocurrency, and set up an automated investing service. They also offer credit cards, insurance, as well as a long list of other financial products and services. They currently have 4 other ETFs according to their website, including an ETF for gig economy companies. But in regards to TGIF, one thing to keep in mind is that this is an actively managed fund, meaning a portfolio manager hand selects the funds that go into this ETF and regularly makes changes as needed. This is different than, say, a passively managed fund, in which the fund would simply follow an index and a portfolio manager wouldn't need to regularly make any changes to the fund. Actively managed funds almost always mean a higher expense ratio that you'll have to pay. However, according to their website, the expense ratio for TGIF is only 0.59%, which is decent. On Investopedia, the average expense ratio for an actively managed fund should be between 0.5 to 0.75%, and anything over 1.5% is considered to be pretty expensive. But I'd have to say the small yield for this ETF is pretty disappointing. It's trading at $103.47 per share, like I mentioned, and it only has a 2.51% dividend yield, which means you're only earning 5 cents a week per share. That's kind of disappointing to me, spending over $100 on one share only to earn 5 cents a week, or roughly 20 cents a month. I feel like someone who would invest in this would probably be very new to dividend investing, and I just don't think these returns would motivate anyone to do more dividend investing later on. But right now I feel like we need to address the most important question in regards to this ETF, and that is, what exactly does it actually hold? Where does it get the money to distribute to shareholders on a weekly basis? If we look at their holdings spreadsheet that's on their website, we can see that this ETF is full of corporate bonds, and it has about 104 different holdings listed as of the making of this video. These corporate bonds are held in a wide variety of industries, like you can see Ford, Delta Airlines, Marriott, and they even have bonds in real estate investment trusts like Iron Mountain, as well as in business development companies like Main Street Capital, which are the type of holdings that I normally cover on this channel, which is pretty cool. Next to the name of the company issuing the bond is the coupon yield, and then next to that is the maturity date. So for example, the bond for Ford has a yield of 8.5%, and it has a maturity date of April 21st of 2023. I've done a little more research into some of these bonds, and based on what I found, I'm almost certain that the majority, if not the overwhelming majority of these bonds, are actually junk bonds, which would explain the higher yields. Junk bonds are considered to be riskier and they have lower ratings by Moody's and the other ratings agencies, meaning that they're at a higher risk of defaulting. But in return, they often give investors much higher yields. Because this ETF is full of riskier bonds, if one of them happens to fail, it shouldn't leave too much of an impact on that dividend, because there are still plenty of other holdings in this ETF that'll still be able to provide interest. But perhaps by this point, you might have thought about the fact that bonds don't pay out interest on a weekly basis, right? Bonds usually pay out interest on an annual, biannual, or monthly basis in less common situations. So how is this fund able to provide weekly dividends? An explanation for this might be that Tgif is probably only paying out a small chunk of the money that they receive from interest, and they just hold on to the rest for future dividend distributions. Now let's look at their dividend distribution history. As we can see, this fund has been able to deliver on its goal on paying dividends on a weekly basis up to this point. But again, I think what's really discouraging here is the puny dividend amount. You're only receiving 5 cents per share per week. Granted, that's 20 cents a month, but right now this ETF is trading at $103.47 a share. That's definitely not a lot of money you're receiving when there's so much better yielding options out there that pay monthly. Let's do some math. If you bought $10,000 worth of this ETF at its current share price, you'd receive 96 shares. Right now, this fund is so young that there hasn't been any dividend increases, so we're just going to assume that the dividend is going to stay at 5 cents a week. 96 shares will pay you $4.80 a week, or roughly $249.60 a year if you don't reinvest. After 5 years, you will have earned $1,248 in dividends, according to the dividend calculator on buyupside.com. Now let's compare that with QYLD, which is a covered call ETF I'm a big fan of for its high yield and its monthly payout. This one is going to be harder to calculate because the dividend changes from month to month, but according to Seeking Alpha, the yearly dividend payout is roughly $2.80 per share. So a $10,000 investment at its current share price as of today will get you 443 shares of QYLD. After 5 years, according to buyupside.com, you'd have about $6,202 in total dividends received without investing over a 5-year period. Overall, guys, I'm just not impressed with this ETF. If it didn't pay dividends weekly, there would be nothing special about this fund. And I think if you're trying to live off dividends, this fund isn't going to get you there anytime soon. This fund is definitely a gimmick in my opinion. Although I should mention that SoFi recently announced that they're planning on launching another weekly dividend ETF, ticker symbol WKLY, in the near future, and that one will be passively managed, meaning it should have a lower expense ratio. So we'll have to wait and see how that performs when it comes out. In this case, people who want more dividend distributions are really going to lose out on earning more money if they were just willing to wait to receive dividends monthly or quarterly. The only possible, conceivable way I could imagine someone really liking this ETF is if they want more emotional satisfaction that comes with dividends arriving in your brokerage account every week. But even then, I would tell you to be patient and wait for distributions every month so you can earn more. If you're seriously interested in earning a good amount of dividends, there's plenty of good dividend ETFs out there that pay monthly. My favorite happen to be covered call ETFs like ticker symbol QYLD, which consistently yields over 11% and has a positive amount of growth in their dividends over time. I made a whole video about it not too long ago if you want more information on it. RYLD is another very good and very similar fund that holds covered calls only in a different stock market index. Another good option is NUSI if you want more downside protection in a covered call ETFs. Or if you want more capital appreciation, just put it in a dividend growth fund like ticker symbol SCHD. Alright, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and also subscribe to the channel if you want to see more high dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to do my best to keep providing you with that knowledge. Feel free to leave a comment below your thoughts and opinions on this ETF. Are you investing in it? Are you avoiding it? Or feel free to share what other ETFs out there you like that provide you with a good amount of dividends every month or quarter. Okay, thanks again guys, and I'll catch you next time. Take care.